Welcome to the Drilling Millions podcast, presented by Sage Dental Partners.
Camille, you're huge into investing, but recently you and I have had some of these chats about crypto and you moving into that space, which I think is grossly misunderstood. You and I have had a cigar and a couple glasses of scotch before I actually fully grasped what crypto was. So why don't you just, at a very high level, because you do a really good job of breaking down crypto into things that are understandable, why don't you just take people through what the difference between crypto and trading / investing are?
Okay, so before I begin, let's talk about long-term investing versus trading. And so usually people would tend to go into the long-term investing side of things. What that means is, let's break it down to make it easy in terms of stocks. So Amazon, Apple, whatever. You pick a stock, you buy it at, let's say, $100, and then you just hold that for like 5 years, 3 to 5 years time, hoping that, the company would still be profitable, innovating, just continuing on that trajectory. And then you just, as a result of that, the stock price would appreciate, right, in value. And we can get into the specifics, but in terms of, we have dividend paying stocks versus non-dividend paying stocks, but we're getting a bit too specific right now. I'm just going to highlight the vast, the general outlook of what that means. So that's that. So then we move on to what's called trading: position trading, swing trading, day trading, and then scalping. And so position trade would fall more into long-term investing. But what that means is you're entering a position with leverage. So you can borrow money. Like basically, you basically like enter a position with like a 3x leverage. That's just a random example.
Yeah.
And that would mean that every increment that it goes up in price would be triple the amount of that increment. Does that make any sense? Like, I'm trying to break it down to make it very simple. Obviously there's more to it, but yeah. So does that make sense to you, or do you want me to like repeat that?
No. That makes sense. So like essentially, I think for some of the listeners, it's like, okay, leverage is, you have your pool of money, right? You have your pool of $1. If you invest $1 and it goes up by double, like, so if the investment, say you buy $1 Amazon stock and Amazon doubles, that $1 turns to $2. But what you can also do is you can have that $1 and then go to, let's say a bank, just to make it simple, or someone who has access to money. And you could say, hey, can you give me money to borrow so I could turn my $1 into $3, or $1 into $4? But then now those $4, they're not all your dollars, because 3 of them belong to the bank, only 1 belongs to you. But the benefit is that if you buy Amazon stock or you buy an appreciating asset, your return automatically multiplies by 3-fold, because now you have 3-fold the amount of buying power.
Right.
The downside is if you lose that, you lose 3 times as much as you ever would have if you had just used your own money.
Exactly. Yeah. And without getting into specifics, like obviously there is what's called a stop loss, and to mitigate that downside. But yeah, so that's position trading, is still long-term, but using leverage. And then you have swing trading, which is like, high time frame, still trading, but you're mostly looking on like daily time frame, 4-hour time frames, and these plays are usually going for like a week or 2 week at a time. Then you're going into day trading, which you're in and out in a single day, but you're still looking at a 4-hour, 1 hour, maybe 15-minute chart, just analyzing the market. And then you have scalping, and scalping is literally looking at like a 5-minute, 1 minute, even seconds time frames sometimes. And you're just getting in and out, and you could be making, risking 1% of your account to make like 10% in a matter of like 20-30 minutes. Obviously, I don't advise anybody to go on that, jump straight into scalping, because it sounds so great, right? But you can also lose money within 20 minutes as well. So Yeah, so that's really the difference between, long-term investors, your typical Warren Buffett style, buy, hold, good growth or value stocks, or even just cryptocurrencies, or just even people long-term hold like the euro, for example, or just the US dollar, expecting it to gain strength against, different types of currencies. People buy different currencies and hold that long term. Like that's a thing. Yeah, so that's really the difference between all of them. And then you have your different markets, like I explained, like you have your foreign exchange market, which is your currency market, you have your crypto market, you have your stock market, and then within the stock market, you have your options trading, you have your futures contracts, so without getting too specific, there's so many markets you can choose from, essentially. The reason why I trade the foreign exchange market, though, is because it's the biggest market. There's about $5 trillion worth of liquidity that goes volume through it a day. So I just like the volatility that it has. Gives me a lot of opportunity to find a setup. And so that's why I play that market. If you're wondering why I chose that market per se. Now, on a different set of things, I don't only just trade the market. I also buy and hold long-term cryptocurrency. And so I do that because, I truly believe in the future of crypto. I don't know if you do. Do you? I think you do.
Well, I've been questioning a lot when I've been down 50% in the past 8 months. So I'm gonna hold just because I'm less of a believer, more just a stubborn guy. So I mean, I'll just keep my losses unrealized for now. But I think I see the validity and I see more and more of the use cases coming up. Yeah, particularly around some of the bigger coins and even NFTs. Like I'm starting to see more of the use cases because I think initially it was like you had to make that argument behind Bitcoin. People would say, Bitcoin, it's just an arbitrary value, but then you'd have to make that argument. Okay, everything's just arbitrarily valued, right? Like the US dollar is arbitrarily valued, gold is arbitrarily valued, your house is arbitrarily valued. So there's a lot of arbitrary valuation, but now it's like when you can use crypto, which in a lot of ways is just software, when you can use that software to solve a real problem, I think that's where I'm long on it. Now I don't know if the crypto that I bought particularly solves those problems, because I just kind of went, a little bit nuts during the peak. But I want to know what you would think though.
In terms of long term?
Yeah, like which ones do you think are going to be or do you think some are just going to completely disappear, or do you think we're like in a somewhat of a winter and they're going to come back? What are your thoughts?
Yeah, so it's funny that we're having this conversation at this point in time in the year and what's been happening this past week. Are you aware of what's been happening this past week in the crypto market?
No idea.
No, so we just had the fallout of like the second biggest, exchange called FTX.
Oh yeah. The guy
Yeah.
lost like 98% of his value in like 24 hours or something, right?
Oh yeah. Yeah, it's just crazy. Like, I'm laughing about it now, but it's not funny when you're thinking about who's actually losing money, which is retail players like me and you, right? It's not really funny when all of them had all this capital locked up and unable to withdraw, and then now there's, evidence that he actually had a backdoor, all planned the whole time, where he's been actually taking the money and just bringing it to his other entity without anybody knowing, without, basically alerting any, like the SEC or anything. Like nobody knew he was moving this capital. He basically created this backdoor and basically just transferring funds to his other entity called Alameda. And so there's a lot of stuff where is coming out and coming up to light where, people got false hope that, okay, yeah, it went down, but I'll still be able to withdraw my funds because he's going to declare bankruptcy and eventually they're going to get the money. But at the end of the day, now, they're saying he himself, being a hacker in the past, has possibly hacked his own exchange and, just actually stolen those funds for good.
Wow.
So yeah, he's on the run right now. Like I don't know, how there's those flight trackers.
Yeah.
Interesting. Like, I don't know if you know, but his headquarters was in the Bahamas recently. And so there's like this private jet that flew, I think, was it this morning or like last night or something? I saw it on Twitter this morning. Anyway, somebody posted about it. And it was like, oh, we have this private jet that's leaving the Bahamas and we have an unknown destination. So he's basically making a run for it at this point. But yeah, so it's interesting. But yeah, going back to your question was in terms of long-term crypto. Yeah, so I would highlight it as yes, when you go and use software to basically come up with a solution to real world problems, I think that's where we're headed. I would agree. Without, I don't want to really say, because it's hard to say which coins you should be investing in, which coins you shouldn't be investing in. But yeah, so going back to the fallout of the second biggest crypto exchange, and then you going, okay, well, do you think all these coins are going to make it or not? No, I actually don't think most of these coins are not going to make it, sorry. Reason being is a lot of them are just pump and dumps. What that means is like people are just, coming up with random projects, shilling them. So basically making them sound super good, or even just like creating, an image that, oh yeah, it has a good potential. People running a bunch of money into it, basically buying it pumping up, and then the founders or whatever, who's behind it all, just sells their entire position and then just crashes the market. Now, this can be done easily in the crypto market because it doesn't take that much money to move price up and down, just because of, the market capitalization of these coins is so low that it's actually easy to manipulate. If you have $10 million, in terms of a bank, that's nothing. But in terms of like if you have $10 million in the stock market, that's not really going to move the price of Amazon because of such, high market cap. But if you have $10 million and you're talking about, one of those lesser market cap coins, you're going to move the market by just a quick buy or a quick sell. So it's kind of scary in that sense because there's so much volatility. But yeah, like going back to it, like you got to pick at, I think the main thing is focus on use case, like you said, and how it relates to real world problems. And if you just go by that, I think the long-termness of crypto is going to make it. But that being said, there's only very few that are going to make it, right? Because there's only very few that are going to have a real solution to a real world problem.
Yeah.
And I think we can both agree on that. So yeah, so I think that's what it is. I'm a big believer in crypto. So, we can go to how much we've invested in
Let's hear it.
Basically all in.
You're all in, huh?
That's what I would say. Yeah. Like a big part of, my net worth as a dental student, as a trader, and also by leveraging few, government funding as well, because, why wouldn't you if you can? I pulled, I would say about 95% of my capital into crypto in terms of, long-term goals. I just think that personally, I'm going to be holding crypto for a long time. And I don't know if you know, but one of the things you can do in the stock market is if you have a pretty good asset portfolio, you can actually take loans against your assets.
Yeah.
I don't know if you know. Yeah, you definitely know that. Like people mostly think you can only do that in real estate, but you can do that with your stock portfolio as well.
Yeah.
What I'm hoping that is crypto eventually becomes big enough that it gets recognized to these, lenders, that they basically take crypto as collateral and give you a loan.
Yeah.
Right.
Because I think right now with stocks, you could do up to what, 80%?
Yeah. So your loan to value would be your LTV, like loan to value would usually be an 80-20, right? So I'm hoping the same comes in terms of crypto. It might not be all the coins, but I'm thinking, Bitcoin might have a chance at it.
Yeah.
So if you can make your money, essentially what I'm saying is, if you can try to make your money as much as you can now, and then just transfer everything into Bitcoin and just hold that long term, and then, start taking loans against it, that would make the most sense to me, right? But
Yeah.
all of it, obviously this doesn't exist yet. That would be the greatest type of scenario, because that's also a method of not having to deal with certain regulators, and having to avoid. I know tax is a heavy, touchy subject for some people, but to put it black and white, yeah, you wouldn't have to pay tax if you could take a loan against your asset.
Mhm.
And so if you can just infer what I mean by that is, that's a good case scenario to be in.
Yeah, but isn't that like how like this ultra rich like Elon, people say, he's worth, what is he worth, like 80 billion or something now?
Yeah,
Like
at this
80,
point, yeah,
90
I don't really
billion.
follow them.
I think at the
Yeah.
peak it was like over 100 or something. But one thing that I learned is that, it's not like Elon's not going to Costco and buying and paying for his groceries with Tesla stock, right? and most of his net worth is actually tied up in Tesla stock. So I don't know what percentage it is, but like liquid capital probably makes up a very small amount of his overall net worth, right? Like it's not like he has 100 billion just to throw around to buy a country. But what I thought was interesting, just kind of building off your point there, was that Elon can actually take loans against his own personal Tesla stock, and then those loans are actually tax free, which is really cool, because it gives him, I mean, some people are going to hate and be like, that's not cool, but I think it's a cool way to have like a wraparound around the system where you can actually take loans out against a asset that's not entirely liquid and make it liquid, so you can actually use it to spend on, say he needs a new car or a new house or whatever it is.
Exactly. Or, you just use it and make more money.
Or exactly, you could do that
Yeah.
too. So
Yeah.
so like highlighting all of these, various methods of I guess spending money and making money between trading, investing, and crypto. It's notorious for people who are traders. Like I think there's a stat that looked into how many people lost money trading on like Robinhood and Wealthsimple and any of these, or any of the crypto exchanges for that fact, or for that matter. Is it wise for, like say in my space, like say in, a dentist sells their practice, they have a huge liquidity event of, a couple $1,000,000. Is it wise for them to actually start day trading, or is investing even, a good option? Because, some people would say investing is, just as risky, because if you're picking stocks, blindly or based on, what your advisor's saying, that's really not as safe as, really investing into an index fund where it's hugely diversified. It's a really good way to maybe not create a lot of wealth, but at least maintain it and have it keep up with inflation. So what are your thoughts on that whole debacle or scenario?
Right. So basically, before we go on that, there's different risk tolerance depending on age, right? So when you're talking about these dentists that are, cashing out of these practices, these guys are most likely 50, 60, even nearing, 50, 60 years old, right? So your risk tolerance is just not, at the same level as, a 20-year-old, just like me and you. So I think at that stage in your life, you're not aiming to make the most money with the highest risk. You're more thinking of mitigating the downside. And so, like you said, if you go and just pick random stocks, you're risking that stock going down, whatever. Whereas if you pick an S&P 500 index fund, for example, you're, basically getting that exposure to the top 500 companies in the US. And then at that point, you're mitigating that downside, right? So I think when you're talking about these 50, 60-year-old people, you have a couple $1,000,000. at the end of the day, you're looking to preserve wealth because trading is very high risk. And I don't know if you know, but the stat is actually like 96% of traders fail, only 4% of them are actually profitable. Because the reason why they say that is because 4% actually have that mechanical edge and have the proper psychology to back it, right? Because it's really that psychology component. Remember, I said 80% psychology, 20% mechanical edge that really make the difference between you being a profitable trader versus a non-profitable trader and just taking all these losses. And at the end of the day, like if you're 50, 60 years old and you went through your whole life never experiencing losses like that, and then all of a sudden you're trying to learn how to deal with losses, I just don't see that going too well, right? So I would stay clear from the trading side of things, just for the reasons I highlighted. But there's also what's called real estate investment trusts. I don't know if you've heard of them.
No, I haven't.
So they're basically a version of an index fund, but they are companies that own real estate, whether it's warehouses, commercial real estate, residential real estate. There's so many on the market, but one that hits home would be smart centers. Do you know smart centers?
Yeah.
You see that, the one with the penguin logo. Yeah. So they own a bunch of property, commercial real estate in Canada, and one of the most famous ones is actually the one in Vaughan, Ontario, where the big Walmart is. And something cool about smart centers is they have a huge contract with Walmart. And I think 30%, correct me if I'm wrong, or, you can search this up later, but 30% of Walmart locations are they're leased out by smart centers. So, that's just to give you an example. So there's just these big corporations that own massive amounts of real estate and just basically are like landlords on a different level and are leasing out to other companies. And so with real estate investment trusts, what I like about them is to be on the New York Stock Exchange, or like this is particular to the US. Canadian has, slightly different rules, but most of these real estate investment trusts are on the New York Stock Exchange. They have to pay 90% of taxable income to investors. That's a rule to be on the New York Stock Exchange. So if you think about it, if I'm investing in we call them REIT as the abbreviation for real estate investment trust. If you think about it, if you have a real estate investment trust that's buying apartments, and all these apartments are yielding rent money from families, and then all that money is being pooled by this company, and then at the end of it has to be distributed, that taxable, after whatever they deduct their expenses and all, the taxable income has to be distributed across the investors, which are the stockholders. You could see why the yield on that dividend, like the yield of the stock, would be higher than most other stocks. And so some of these, like what I like about it is a lot of these real estate investment trusts actually are yielding like 4 to 6% a year. And that's unheard of, right? Usually in terms of dividends.
Right.
Sometimes they even go up to 10%, 12%. I've even seen 15%.
Wow. So for...
Yeah, you're beating COVID inflation at this point.
So for the listeners that aren't familiar with what dividends are, what are dividends?
So basically dividends are a way for so let's say you hold stock of Apple. Apple may decide to pay their investors money for holding their stock. So they're basically giving you an incentive to buy the stock. That's essentially how I would put it. Mm-hmm. That's the easiest and simplest way to put it.
Yeah.
And not every company has to pay dividends. It's a choice. But when it's particular to real estate investment trusts, they do have to. And that's kind of why, it's kind of like a secret thing that nobody really talks about. But I kind of want to, put it out there because I think it's cool. Yeah. And it'll help a lot of people.
Yeah. So by the sounds of it, the name of the game really depends on what your risk tolerance is, right? Like you said, if you're a URI, sending it on a crypto investment, probably not probably not the best idea in the world, but probably not the worst idea in the world. If you're in, the back nine of your life or your career, you probably don't want to be making those, rash decisions unless you are okay with losing them, right? So it's like, you really want to preserve your wealth, you should be diversified as much as possible. And it's the most boring thing in the world, because it's not, it's not some GameStop, it's not some Bed Bath and Beyond. It's just, real simple: diversify across markets, diversify across countries, diversify across asset classes, right? And hopefully that, the losers in that portfolio will, the winners will make up for the losers, and the losers won't be so bad, because eventually if you look at the global economy, it's kind of like a closed system, right? Like, someone has to win while another one loses. So if you can just, make sure you're a bit shielded from those big dips in the market, I feel like that's probably, just from what you're saying, the best way to go about it. If you're not, in the send it portion of your life.
Exactly. Yeah. And like, having that crypto exposure early on, going through all these dips like we have
Yeah.
recently, I think it'll just make us stronger for, any other market that we enter in the future, whether real estate, just traditional stocks. But yeah. So just to conclude that point, like, if you're in the, the last leg of your career, I just think it's not smart to be trying to make, that huge return on investment that cryptocurrency could possibly bring. Because side is, just as bad, if not worse. Like that June crash was insane, right? We saw crypto, some of these altcoins were just, 80, even 90% down, right? So, if you ever told that to a traditional investor that's probably 60 right now, he'll just, turn away from you right away. Like, he's not even going to want to, hear it. Like 90% drawdown, like, what the fuck, like it doesn't make any sense. But yeah, so I just think your 20s are, learn as much as you can, try new things, get out there, just do it, because you'll never know if you don't try, right? Yeah. And so, like I said, this comes down to learning how to fail. And I think learning how to fail just teaches you so much, and you have to just fail, like, just do it, because it's not that bad. Like, you expect failure to be bad, but when you actually fail, is it really that bad?
Yeah, exactly. It's
that's the way I feel. Yeah.
It's like simple hedonic adaptation, right? Like, your highs will never be as high as you think they're going to be, and your lows are never going to be as low as you think you're going to be. It's just your life is basically just, it's kind of a hopeless perspective to take, but your life is just sort of where it's at, like, there's very few things that are going to make you exceptionally happy, so people think, like, once I, get that 6-pack, once I get a girlfriend, once I get $1 million, like, I'll be super happy. And then on the other side of it, on the flip side of it, it's like, thinking of your worst case scenario, like going bankrupt, probably would suck, but like, you're not dead, right?
Yeah.
And so exactly. It's just looking at it from that perspective. But, I think the moral of the story is really, there's no one size fits all investment philosophy. It really depends on your situation and where you're at. Like, I think when people say you should diversify when you're starting off with a $5 portfolio, it's like, you're going to be waiting a long time for, anything substantial to happen. But like, I think if you're in the more, like you said, wealth preservation mode of your life, you probably shouldn't be in those high volatility areas, because that's probably not going to serve you very well. Exactly.
Yeah. And then relating it back to, like, your traditional pathway as a dental student into your dental career, you're 25, just like I am. And, we're nearing these final years of our, student life. This is the time, I get it, we're still in massive amounts of debt because, it costs so much money to be here. But at the end of the day, this is also the best time to take the highest amount of risk as you can, because you're already down bad. Let's be real. Like, you're already like 500K in loans. What's another couple $1,000s on 500? 500, right? Like that's the way I see it, to be
Yeah.
honest. So if you're going to invest, you know, a couple thousand, 1 to 5 grand in the cryptocurrency world, what is that when you're already down 500K, right? It's negligible. So I think you're a solo person. Surely you might have a relationship, but okay, you don't have kids, you don't have dependents. No one's really like banking on you if you do go bankrupt, right? Like it's
Yeah.
just you. And I think that if you go through failures now, when you're older and you do go and buy your practice, or you know, go open up a Papa John's, for example, I don't know, you know, you may do, and it fails, you'll at least know how to recover from that. Whereas if you never failed and then going up that Papa John's and it fails, that'll be your first failure, and then you're just gonna panic, but you're also gonna have a family that depends on you, which is, I think, worse. So I think while you're single, you should take the most risk. And then when you have that, you know, you take that next step, get married, whatever, have kids, you know, because I'm relating this back directly to like your traditional pathway as a dental student, your dental career, but also, you know, your family life. Yeah, it just makes the most sense to be taking the most risk now and then, you know, chill down later, right? Because I think if the high risks work out, you'll be in a really good spot. But if they don't, you'll always be able to make a comeback.
Yeah, exactly.
Right? Whereas if you have a kid, you don't want to make other people suffer because of your stupidity, right? So yeah, that's a good way to conclude that point, I think. And I don't know, would you agree with that?
Yeah, I think so. I always think back to that stat about Warren Buffett. It was like 99% of his wealth was created after the age of 65, and 98% of it was made after the age of 50 or something bonkers like that. And it's just like, you know, if you're gonna make these big bets, right now we have time on our side, and you know, we have time to, you know, if you even want to like invest in crypto, or you want to invest in some, you know, stupid stock that's probably not going to go anywhere when you're 25, you know, give it a 60-year time horizon. You know, it may turn out to be nothing, but one, your downside is so little, but your upside is huge because time is on your side. So, you know, even ignoring like the whole, like, because some people do at this age have a lot depending on them, and they're, you know, they are up against the wall, but the premise of, you know, you have so much upside for, you know, pretty limited downside at this stage of your life, like I think it's a really good one.